Let's get straight to the CEO of the world's largest bond fund manager, Mohamed El-Erian of PIMCO, a familiar face on our program. He is joining us live from Newport Beach, California. Mohamed, great to see you again. I know you're back actually from just a major sort of tour of what is going on in Europe right now. You know, what do you express from what we've seen so far with the G20? Is it disappointment? Is it concern? What?
It's both. And good morning, Betty. Disappointment and concern. I mean, it's striking that Mrs. Merkel came out this morning, as you reported, saying that they couldn't even agree on the easy part. And the easy part was enhancing the IMF resources in order to help Europe. So I'm both worried and disappointed so far. Hopefully, something will happen in the next day or so, but so far the signals aren't really good.
But what? What would hopefully happen, Mohamed?
So we need four things, Betty. First, we need agreement on Europe. We need to stabilize the European situation. Second, the world has to come together and agree on a growth and employment pact. Just like it did back in April '09, when it was a financial crisis, today we have an economic crisis and an employment crisis. So we need to see different countries coming together with a common purpose. Third, let's not forget the hotspots in the world, including North Africa. We need something there. And finally, there are the longer-term issues that are just as important, climate change. So that was the original agenda,
right.
But I'm afraid that the G20 got hijacked by Europe.
Well, you just came back from Europe. I mean, what is your assessment from having been there?
Unfortunately, it's a mess. You know, there are three parties to a solution, and all three are unraveling. There are the debtor countries, and they're starting to have even bigger political issues. See what's happening in Greece. There are the official creditors, and they can't agree on providing support. And then there are the private creditors, and it's not sure that you're going to get the banks, all of them, to agree to the 50% reduction in Greece, which is the minimum Greece needs. So I'm afraid it's a bit of a mess out there.
Right. So here we are, a few days after, about a week after, you know, the EU planned the debt deal, and as you say, now we've come back almost to square one. In many ways, Mohamed, are we worse off now after having gone to this agreement last week than we were before?
Yeah, we are, because every time you get to an agreement and it unravels, the credibility of the process gets undermined. Remember the image, always keep this image in your mind of the snowball rolling down the hill. The problems get bigger and it becomes even more difficult to control the snowball. So we can't afford disappointment after disappointment. Europe needs to turn the corner and start building the basis for a solution.
And Mohamed, I want to get your take on this. You know, the Italian Prime Minister, Silvio Berlusconi, comes out and says, look, the euro has really screwed us. I mean, those are pretty strong words coming out from the leader of Italy. I think even the leaders there are questioning whether or not they should belong in the euro right now.
You're getting leaders say strange things. So it started with Mr. Sarkozy last Thursday when he said Greece should not be in the eurozone. Now you're getting questioning left, right, and center. I think the leaders need to get on the same page. The narrative is important here. But you know what? When there are difficulties, there's a conflict between the regional priorities and the national realities. And that's what we're seeing in Italy, that's what we're seeing in Greece, and that's what we're seeing in countries like Germany and France as well. So this is a very delicate period.
Well, we are back with the CEO of the world's largest bond fund manager, Mohamed El-Erian of PIMCO, economics editor Mike McKee, also joining me now as well. And Mohamed, let me just turn to what we're seeing in the U.S. jobs market, because you and I have talked quite a bit about how scary sometimes the data has come in. Now, today, though, for the month of October, it's actually been not too bad. So does that give you any more confidence that we may be going from this stall speed that you've talked about in the American economy to some escape velocity?
The good news, Betty, is that the report in relative terms was better than expected, and mainly because of the revisions to August and September. The bad news is that we're still in this unemployment crisis. So no, it doesn't do enough to remove the risk of stall speed, which is growth, but not fast enough growth. We need to see much higher employment creation to get over this issue.
What do you think it's going to take, Mohamed, to get that at this point? Are we unable to get there because of the overhang from Europe?
I think Europe is an issue, but I think, Mike, we also have fundamental issues. We have structural problems in the labor market, in the housing market, in the credit market. We don't have enough infrastructure. So there are a series of structural issues. We also have to reconcile medium-term fiscal reform with short-term stimulus. So there are some big issues that are not as yet addressed sufficiently, and certainly not addressed in a comprehensive manner.
But, even if we do try to address that, Mohamed, is there some risk or an increasing risk that we're losing control of our own economy because of what's going on in Europe?
I mean, the reality, Betty, is we live in a globalized economy. Europe is a major economic area. It's an important trading partner. European banks are an important part of the financial situation. So no country, whether it's the US or China, is totally immune from what's happening in Europe. The important thing is to be able to navigate it, and that depends on your internal dynamics. So we're not immune from Europe. Nobody is in the world, but different countries are better or less able to navigate it.
But then how would you say that the central banks have been handling this so far? Everything from the ECB to what we heard from the Fed.
They've been doing the heavy lifting. The Fed in particular has been the only policymaker really in play. The problem is they don't have enough instruments. You must always remember that central banks are monetary institutions. As such, they can only be a bridge to somewhere. And in order for them to be a bridge to somewhere good, you need other policymakers to also contribute. And that's what has failed Europe, and that's what has failed the US so far.
Mohamed, very quickly, in August, we did not see markets melt down during the fiscal follies in Washington. We haven't seen it during what's going on in Greece. When do markets tell politicians enough?
Well, I'm not sure people would agree with you, Mike. I mean, the third quarter was pretty brutal for the equity market, certainly, and for some other markets. I think the markets are telling politicians, just the volatility, Mike, just the volatility does damage to the functioning of the market. So if the policymakers haven't heard the signal yet, we are in deep trouble.
Mohamed, we were all in many ways caught off guard by this huge October rally, right, in the equity markets that we saw. It seemed like the risk on trade was back. So do you believe, judging from what you've seen so far, is that the end of it, that's the rally that we got, and we're not going to see any more like that for a long time to come?
Betty, just think of the whole list that Margaret just said. I mean, this is an incredibly headline-driven market. It's a macro-driven market as opposed to a bottoms-up market. So I think what we should expect is enormous volatility. What we would suggest to investors is to play general defense and selective offense. I think it's important to be generally defensive because the world is very fluid, but there are values out there. So combine the general defense with a bit of selective offense.
But Mohamed, when people hear that, though, then they worry, though, that if they're not positioned somewhat more aggressively, they're going to miss a run-up like what we saw in October.
Sure, that risk is always there, Betty, but think of what's the bigger mistake. Okay, is it leaving some money on the table or losing your capital? We are in such a fluid world right now where the left and right tails are so large that I don't think you can be symmetrically positioned towards either risk, because one of them is very difficult to recover from. So that's why general defense makes sense in this incredibly volatile, headline-driven market.
And Mohamed, just very quickly, in terms of value, do you see more value staying in the United States than in Europe?
I see value where balance sheets are strong, where companies are exposed to growth in emerging markets, and where they're relatively immune from erratic policymaking. That's where value is, and it's all over the world.
Okay. All right, Mohamed, great to talk with you and to stay with us throughout this half hour talking about the U.S. and also Europe. Mohamed El-Erian, the PIMCO CEO, joining us from California.